Good. So if you look at that question, you're able to deal with the variance part of it. You are able to deal with the variance part of it. So what you are required to do is to do a reconciliation statement. What was remaining is a reconciliation statement. A reconciliation statement. Good. So for us to do the reconciliation statement, we are told to do the reconciliation statement of the budgeted contribution. So you have to get the budgeted contribution compared to the actual contribution. Then we get to have the reconciliation statement, right? So what I want us to do is come up with a budgeted. What we given budgeted contribution, not clear, but you can get it. Budgeted contribution. So budgeted contribution, we need to get sales, right? Sales, so we given sales. We're given a selling price per unit, which is 136. So how many units were budgeted? Budgeted production, do we have that information anywhere? Budgeted production, additional information number one, that is 38,000. So 38,000 by 136. What will you have? What will you have? What will you have? What will you have? What do we have? 51,68,000. Good. Then from the sales, we need to less variable production cost so that we get what we call contribution, right? So less production, and we have to be specific at this point. We must be intentional in what we're doing. So at this point, we're talking about less variable production costs. Not just any other cost, but variable production cost. So one of the variable production costs, we have direct material, or we have materials. Materials, we are told they require 3 kgs, whose cost is 20 what? 20 shillings. For how many units? For 38,000. So 20 by 38,000. 20 by 38,000, tunapata ngapi? 20 by 38,000, 760,000. Good. Then we have labor, we have labor. So labor cost, we are told they need 3 hours of 24 shillings per hour, giving us 72 per unit. And they're supposed to produce 38,000. So 38,000 by 72. What are you getting? What are you getting? $27.36. Good. So once we do that, we'll be able to get our budgeted contribution. So can we have budgeted contribution? What is our budgeted contribution? Budgeted contribution, 1762. Good. Then we move to the next one. Now, under actual sales or actual contribution statement, we have it in additional information number 2. Production and sales. They produced 30,000 and sold 36,000 and sold 36,000, right? So you take 36,000 multiplied by the selling price. The actual selling price is given as 134. So can we take 134 by 36,000? 134 by 36,000 tunapata ngapi? 1672. Good. So 134, 134 by 36,000. Ni ngapi? 134 by 36,000. 4,824. 4,824. Then you move to the next one. So from the same, you need less material, right? So less material, the actual materials cost. Then of course, less labor cost. So the material cost, the actual material cost as per this question, 754. Actual labor cost as per this, 2,656. 2,656. What do we have? Actual. Contribution. So actual contribution. What are you getting? Actual contribution. Actual contribution in ngapi? Actual contribution. Is it 14? 14. It was an assignment, by the way. That's how wengine hawakufanya assignment. But we shall overcome. Reconciliation. Reconciliation statement. So this reconciliation statement, we are trying to reconcile this difference. Why are we having difference between actual contribution and budgeted contribution? Why is that difference? Why is that different? So we come up with the budgeted contribution and look at the things that affected it to give us a lesser actual contribution. So we start with budgeted contribution. Budgeted contribution. Budgeted contribution, we are having 16,72,000. Then 16,72,000, we need to do adjustment for variances, right? So let's have adjustment for variances. Variances. Remember, variances will be adding or deducting depending on the nature of that particular variance. So good. So we are doing this. We had changes in sales due to the difference in selling price or difference in quantity, right? So we're talking about selling price variance. That is a marginal volume or sales margin. We're talking about sales margin. Sales margin volume variance, right? Then you move to material price variance, material usage variance, material usage variance. We talked about labor. So let's have this one here. What is our selling price variance? You have to tell me the sign or the nature. Is it favorable or adverse? It was 72,000 adverse. Good. How about sales margin volume variance? Sales margin volume variance, we had 88,000. 88,000 adverse. How about material price? Material price variance, 6,000 favorable. Positive 6,000. Material usage variance. Material usage variance, 40,000 adverse. Good. Then you move to labor. So labor, we add two things, that is labor, right? Variance and labor efficiency variance. So what was our labor rate variance? What was our labor rate variance? What was our labor rate variance? 80,000 favorable. What was our labor efficiency variance? What was our labor efficiency variance? 144,000. Was it 144 or 140? 144,000 adverse. Good. So when we deal with all these variances, what are you getting? Net effect. Net effect of these variances. Basically take negative 72,000 minus 88,000 plus 6,000 minus 40,000 plus 80,000 minus 144,000. What are you getting? What are you getting? What is the net effect? 170,000. Give us the sign. Is it adverse or favorable? So Maureen is giving us 170,000. Someone else to confirm? Or please disagree with that by giving us a different answer. Someone to confirm or disagree with that by giving us a different answer. 258,000. Remember to put a negative upper, negative 72, negative 88. That's around 152. Actually 160. Yeah, 160 negative. 200 negative plus this will give us something like 140, 180, 384, 384, 384. That's adverse, right? Then we add a positive, we only have 86,000. It must just be 200 and something. It must be 200 and something, 200 and something. 258,000. So we have 258,000 adverse. 258,000 adverse. That's a negative. So 1672 minus 258,000. What are you getting? What are you getting when you take our positive minus this negative here? These are negative. So can you add the two? What are you getting? Net amount. Net amount ni ngapi? 14. 14. 14, 14. Okay, that's the net amount. Is it equal to any net contribution here? If yes, give me the name of that contribution. What is the name of that contribution? What is the name of that contribution? Actual contribution. Actual contribution. So at any given time, you are told to come up with a reconciliation statement. Remember, that reconciliation statement will not come into existence until, number one, you look at the budgeted statement. If it is not given, you have to prepare it the way we have done, because we are given the items. Number two, you prepare the actual statements using the actual results, right? To give us the net item. Is it net profit? Is it total cost again, right? You look at it, then you come up with the reconciliation statement. So look at the budgeted sales and actual budgeted contribution and actual contribution. For budgeted cost and actual cost, you'll be able to see there's a difference. So the difference between budgeted contribution and actual contribution in this case was not caused by just one item. No. You can clearly see, number one, it was caused by price variance, differences in selling price. It was caused by differences in volume of units sold. It was caused by differences in price of raw material. It was caused by differences in units of raw material utilized, right? The efficiency, the effective use of material. It was caused by difference in labor rates, right? Because labor rate, you can see, we don't have a flat thing, we don't have zero. It means it also led to one of the variances. It has been contributed to by, again, what you call labor efficiency. But as how effective is this company utilizing its labor? They are not so effective. And you can see we have negative variance in terms of effective utilization of the labor hours. And of course, if you get the net effect of these variances, you're able to see it gives us the actual contribution. So do you have an hint on how to deal with the reconciliation statement? Do you now have some knowledge of dealing with the reconciliation statement? Do you have some knowledge of dealing with the reconciliation statement? Great. So being that that's what you are required to do, I want us to move to, we can move very fast to December 2022. December 2022. December 2022, I introduced something there. December 2022. Let's move December 2022. CPA, past paper. Question should be number 4 or something there. December 2022, question number 4. Question number 4B. And we introduce some speed. Great. So December 2022, question number 4B, we are being told Quota Limited, a manufacturer or manufactures and sells a single product branded TT with a standard cost of 1,100. The standard cost is made up of, number 1, direct material, 15 square meters at 30 shillings per square meter, 5 hours at 100 shillings per hour, variable overheads 5 hours at 30 or at 20 shillings per hour, fixed overhead 5 hours at 10 shillings per hour. The standard selling price per unit is 1,300. That is now the anticipated or the budgeted selling price. The monthly budget projects production and sales of 1,000 units. Budgeted production and sales 1,000 units. Actual figures for the month of November 2022 are as follows. Number 1, sales 1,200 units at 1,320. Actual production 1,400. Direct materials 22,000 square meters at 40 per square meter. Direct wages 6,800 hours at 110. Variable overheads 110,000. Fixed overheads 60,000. Material price variance and material usage variance. Labor rate variance and labor efficiency variance. So you can even look at, do we have selling price given in the first part? Yes, we are given selling price. So we can start with the selling price variance. So let's start with the selling price variance is equal to standard price minus actual price multiplied by standard quantity actual quantity. When you compare prices, you must use actual quantity. Actual quantity sold, right? Good. So do we have the standard price? They budgeted to sell this product at what price? 1,300. They ended up selling it at 1,320. Actual quantity sold 1,200. Please give me the variance and the sign. It is very important to me to evaluate whether you are getting the concepts or not. Give me the variance. Give me the variance. I can see the variance there. Yeah. We have the variance with us now. We have the variance with us now. Good. So let's see what people are getting here. Let's see what people are getting here. Let's do it very fast. Very fast. What our machine of finding sample? 1,300 minus 1,320. See only 20. Difference in 20 times 1,200. Finito. times 1200. See Vivo. 20 times 1200. The answer is 24,000. So what matters now here is actually knowing whether it is favorable or adverse is only done at this particular point by just looking at this bracket and referring to your formula. This one here, we are referring to the sales. So the sales is what brings money into the business, right? That's cash inflow item. They said they budgeted to sell each unit at 1,300. They ended up selling each unit at 1,320. Are they going to celebrate over this or not? They should be celebrating over this because they have made an extra revenue of 20 shillings per unit. So if you add adverse, it means you are receiving this as an expense, but it's a cash inflow item. So you have to bring in favorable values. Have you seen now how to interpret this part? It's the reverse of what maybe we have been doing under cost. So you have to consider cost and variance. I mean, cost and revenue items. Is it clear to those who gave us adverse? Have you seen the reason why we are putting favorable? Have you seen why you are putting favorable instead of adverse? Great, thank you. So again, we get to the variance can be as a result of difference in volume, right? So let's look at sales margin volume variance, which is equal to standard quantity or budgeted quantity or budgeted volume, right? Standard quantity or budgeted quantity, right? Budgeted quantity minus actual quantity. And this time around we multiply by the standard margin. Standard contribution margin. Good. Standard contribution margin. So do we have the items to give us that margin per unit? Standard contribution margin per unit or standard unit contribution margin. So let's see what we have there. After the standard, they are telling us the direct labor, indirect material, direct labor, variable overheads. We have fixed overheads. Fixed overheads not from part of margin. Fixed overheads not from part of margin, right? So it is not forming part of margin. We know very well. We'll only be taking the variable cost. Were we given budgeted selling price? We have it up here. So margin is equal to budgeted sales, right? Budgeted sales of 1,300 minus budgeted material cost for 50. That is per unit minus 500. That is per unit minus 100, which is variable production. So what are you getting as the margin? What are you getting as the margin? 1,300 minus 450 minus 500 minus 100. You only 950, 1050, 1050. 1,300 minus 50 minus 10, about 250, right? Good. They budgeted quantity, budgeted production and sales. So we're talking about budgeted sales. They budgeted to sell 1,000 units. They budgeted to sell 1,000 units. They ended up selling actual quantity sold 1,200. Please advise these people. Advise these people. Is it adverse or favorable? Before even you get the actual answer, is it adverse or favorable? The budgeted quantity is not 1,000 units. Wow. Okay. Budgeted quantity ni ngapi? Someone to help us. Budgeted quantity to be sold ni ngapi? Budgeted quantity to be sold. What were we given? The question. Budgeted quantity below the standard cost, that is below the fixed overheads. They are telling us the standard selling price per unit is 1,300. The monthly budgeted or budget projects production and sales of how many units? How many units? Help us get that figure or confirm whether you've been able to see where your problem was. Have you identified your mistake? I believe so. Great. It was 1,000. So here, they budgeted to sell only 1,000 units. They ended up selling 1,200. So automatically, what are we talking about? Wacha tuone. Again, we're talking about adverse. we are not we are not dealing with expenses. We are not dealing with the quantity of raw material to be used. We are dealing with what we are going to sell. Remember, as we increase the quantity to be sold, we are increasing revenue, right? The quantity sold is a cash inflow item. If I sell more than what I budgeted for, I must celebrate on that day, right? So it will be favorable. So can you give me the actual amount? The difference here is 200. 200 by 250. Is it 50,000 or 5,000? Is it 50,000 or 5,000? 50,000 favorable, right? 50,000 favorable. Great. 50,000 favorable. Then from that, we are now getting to expenses. We are getting to expenses, right? So under expenses, we talk about material price variance. So material price variance is equal to standard price minus actual price multiplied by actual quantity of raw material, right? So standard price, direct material. What was the standard price per unit? Standard price per unit of raw material ni ngapi? Standard price of raw material. Standard price of raw material. Sasa watu hawanangi hizi vitu. Look at the standard cost card up there. Material is measured in square meters. So what were we told as per that question, or what have they said is the cost per meter of raw standard price per unit of raw material. Note, I can see people are confusing these two things. They have said the company needs 15 square meters of material at what price? At 30 shillings per square meter to produce 1 unit of TT. So for them to produce a unit of TT, they need 15 square meters. But 1 square meter is equal to 30. So that's why when you take 50 by 30, it's giving us 450. So 450 is the cost of raw material required to produce 1 unit of TT. In this variance function, we need the standard price per unit of raw material. 1 unit of raw material, right? 1 unit of raw material is equal to 30 shillings per square meter per unit. So what we are required to insert here is the 30 shillings, not 450. Good. Actual price. What was the actual cost per unit of raw material? What was the actual, or what is the actual price per unit of raw material? 40 shillings per square meter. But before you look at the actual quantity purchased, they plan to spend 30 shillings per unit of raw material. They end up spending 40. Which kind of variance is this? Adverse. So now we can consider the actual quantity of raw material. So materials, they use 22,000 square meters, 22,000 square meters to be able to do actual production. So what is our variance? I know it is adverse. Adverse. So 30 minus 40 will be negative 10. Negative 10 by 22,000. 22,000 or 220,000 adverse. Let's go to material usage variance is equal to standard quantity in actual production minus actual quantity of raw material used multiplied by standard price. Standard quantity in actual production. So they budgeted that every unit of product TT, every unit of product TT requires 15 square meters of this raw material. Every unit of product TT requires, as per the standard, 15 square meters of raw material. It is standard quantity of raw material required to produce 1 unit of TT times actual units produced of the finished product. So actual production was given under information number. The second part of this question, below sales, we have actual production of 1,400. On 1,400, right? Then we compare with actual quantity of raw materials. If you can have an actual quantity, 22,000. 22,000, then that should be compared with standard price if we have up here. So before I even go to the standard price, I need to consider this. Can we take 15 by 1,400? 15 by 1,400 ni ngapi? 15 by 1,400 ni ngapi? 21,000. So they plan to spend 21,000. They ended up spending 22,000. Is it something nice? Is it something nice? No, it is adverse, right? They spend more than what was budgeted. And because these are an expense, they must be worried about that over expenditure. So 21 minus 22 will be having 1,000 negative. 1,000 by 30, 30,000. Of course, adverse. Good. That's what you're having. That's what you're having. That's what you're having. That's what you're having. Good. Then we go to the next one. 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 Which one is it? The next one is from material we go to labor. So let's look at labor rate variance. Labor rate variance, standard rate minus actual rate multiplied by actual hours. Standard rate, direct labor 5 hours at 100 shillings per hour. Can you give me the rate? Standard rate? 15 imetoka wapi? 15. The first table there, the standard cost card tells us Quota Limited manufactures and sells a single product branded TT with a standard cost of 1,100 made up as follows. Number one, direct materials in bracket 15 square meters at 30 shillings per square meter. The standard quantity of raw material in actual units produced. I believe your question is answered. I believe your question is answered. Standard rate, 1,100. Standard rate here in our standard rate, standard rate. Standard rate. What is the labor cost per hour? The standard labor cost per hour ni ngapi? Tumeambiwa direct, just below that, direct labor 5 hours at 100 shillings per hour. So that is the rate per hour. That's what we are looking for. Is 100 shillings per hour as per the standard. What about actual rate? If you go to information number just below that, actual figures for the month of November. What was the actual amount paid per hour? Direct wages, 1,600 hours at 110, right? 110. Then you multiply by what? Actual hours, 6,800. So look at these ones here. They said a standard of 100, they ended up paying 110. Can you tell me the type of variance? Is it adverse or favorable? Adverse. Thank you. So the difference is negative 10. 10 by 6,800. Adverse, right? Good. Then you go to labor. Now, what you need to understand is, we cannot talk about labor price variance, right? We pay for the services. So it is labor. Right? Look at it, standard price, standard rate, actual price, actual rate, actual quote. Don't purchase labor, but we pay for the hours. So that's the only different thing there. Good, let's have labor efficiency. How effective are you utilizing the labor that has been paid for? Labor efficiency variance is equal to standard hours in actual production minus actual hours multiplied by standard rate. So can someone give us standard hours in actual production? Standard hours, how many labor hours were utilized to produce 1 unit of TT? Labor hours required to produce 1 unit of TT as per the standard cost. How many labor hours? 5 hours are required to produce 1 unit of TT. So that's the standard labor hours multiplied by actual production. What are we producing? Product TT, which you are told actual production is 1,400. Then we compare with actual hours, which is actual hours to make me upper inject 6,800. Then that we multiply by the standard rate. Standard rate iko wapi? Ndio hiyo hapa juu 100. Before even I get the answer, I want us to get 5 by 1,400. Ni ngapi? 5 by 1,400. 5 by 1,400 ni ngapi? 7,000. As per their budget, they budgeted to spend or utilize 7,000 hours. They ended up utilizing 6,800 hours. Is it something they should be happy about? Yes, they spent less. They paid for less labor hours. So can you now give me the difference? 200. 200 by 1,000? By 100, sorry, 200 by 100. And I've been told is favorable. Right? And I've been told is favorable. Good. Can we look at, yes, we have everything with us, so we can go ahead and do it. Variable overhead. Variable overhead expenditure variance. We don't talk about variable overhead rate variance. No, variable overhead expenditure, because it is being arrived at by looking at the absorption rate. Variable overheads absorbed, right? Variable overheads absorbed. We would have talked about standard rates, and the only difference actually, we will compare the answers and see, right? We'll compare the answers. If this one here was not being absorbed, then you could have talked about variable overhead rate variance is equal to standard rate minus actual rate. The same things we have up here. The only difference is we have actual hours. And when we talk about standard rates, you are able to recall we're talking about variable overhead absorption rate. I do not know whether you are getting me. Let's talk about variable overhead absorption rate. If they are being absorbed based on labor hours, then variable overhead absorption rate will be, let's say 30 or 20 shillings, right? 20 shillings per labor hour, right? 20 shillings per labor hour. We could have talked about this. Right? The standard rate. That's standard rate. So the standard rate is actually referring to what we call variable overhead absorption rate. And because variable overheads are absorbed based on the labor hours, we don't talk about the rate. So the right term to use under variable overhead is not variable overhead rate variance. It is variable overhead expenditure variance, which is equal to budgeted variable overhead minus actual variable overhead. But budgeted variable overhead is equal to variable overhead absorption rate multiplied by actual activity. Multiplied by actual activity level. Good. So let's see what we are going to add here. Variable overhead expenditure variance. Do we have budgeted variable overheads? We don't have total amount. So you have to calculate it. How do we calculate it? Look at the formula down here. Variable overhead absorption rates. So if you have been killed, in our class during topic number 7, during the last part of topic number 4, you should be able to straight away give me variable overhead absorption rates. So please go to the question and give me variable overhead absorption rates. Go to the question and give me variable overhead absorption rates. And then give a unit there. So what is the variable overhead absorption rate? Variable overhead absorption rate is that rate being charged per activity level. You have been able to see that the variable overheads, as per the standard, we have 5 hours at 20 shillings per hour, giving us 100 shillings. So what is this variable overhead absorption rate? It is dependent on labor hours. So if you go to the budgeted statement or standard cost cut, and then you're able to see the variable overhead rate per direct labor hour, you'll be able to give us that overhead absorption rate. So Ningapi, look at the question. You have it there. You don't even need to calculate anything. You copy and paste. When you give us 100, 100 is the cost required to produce 1 unit of what? Of TT. They're utilizing 5 hours, and each hour is 20 shillings. So when you multiply that, you get 100. 100 is for 1 unit of TT. But what is the cost per hour? What is the cost per hour? Refer to the standard rate when you are calculating labor rate variance. What is your standard labor rate? Standard labor rate? Standard labor rate. What did you pick? 100. Are you able to see what is equivalent to 100? Under variable overheads, are you able to see the equivalent item there? 20 shillings per direct labor hour is the variable overhead absorption rate. Is the variable overhead absorption rate. 20 shillings per direct labor hour times actual activity level. Are you able to see actual activity level? Actual activity level, it is dependent on actual labor hours. So the overheads absorbed will be budgeted, variable overhead absorption rate times actual activity level. Actual activity level, they are absorbed based on labor hours. So what is actual labor hours? 6,800. What are you getting? What is your budgeted variable overhead? Budgeted variable overhead ni ngapi? Budgeted variable overhead 130 what? 136,000. 136,000. So we have 136,000 as the budgeted. We have 136,000 as the budgeted variable overhead, and of course we have actual variable overhead. Actual variable overhead. So let's look at this. Variable overhead expenditure variance. Variable overhead expenditure variance, right? It is budgeted variable overhead. They budgeted to spend 136,000. They ended up spending the actual variable overhead. So do we have that? Do we have that in the question? Actual variable overhead. Actual variable overhead in variable overheads 110. Is this something to be happy about? Is this something to be happy about? Yes, they should celebrate over that. So what's the difference? Is it 26,000? Is it 26,000? 26,000, 26,000? Yes. And they should be happy about it because they have saved 26,000. Alternatively, they have said variable overhead rate variance is equal to standard rate minus actual rate multiplied by actual hours, right? So this under actual hours, we don't talk about actual hours. We are talking about variable overhead absorption rate. Sorry, actual hours. Actual hours. What I was replacing this variable overhead absorption rate. Then multiply by actual hours. Actual hours. Because they are dependent on labor hours. So let's see if this one will give us the same thing. Variable overhead absorption rate 20 minus actual rate. So do we have actual rate? Do we have actual rates? Variable overheads, you are only given expense, right? So how do we get actual rates? It is that expense, right? It is that expense divided by actual hours. So what is the actual hours? 6,800, right? You can clearly see where it's taking us to. So 20 minus 110,000 over 6,800. And at the end of the day, we are getting back to what? 6,800. This remains to be 110,000 if you break the bracket. And of course, 6,800 by 20 ni ngapi? 136, right? So before you get to 136, can you give me this? Maybe as a decimal to 2 decimal places. In 2 decimal places, 110 divided by 6,800. 110 divided by 6,800 ni ngapi? 16 point. So you can compare 20 and 16.1. 8, right? You can clearly see if you plan to spend 20, you ended up spending 16.18, you've actually saved, right? So what have you saved? What have you saved? It is going to be favorable, right? So can you take that ratio? The way it is, don't interfere with that ratio. Multiply by 16,800. Multiply, or take 20 minus that ratio, then you multiply by 1600. What are you getting? We've known that it's a favorable. So what are you getting? What are you getting without rounding off anything? What are you getting? Are we getting back to 26,000? Are we getting back to 26,000 favorable? Are we getting back to 26,000 favorable? Yes. Good. This method will give you the answer. This approach will give you the answer. But when are we talking about variable overhead rate variance? Yet it is absorbed. So we talk about variable overhead expenditure variance, which in other terms, we call it variable overhead absorbed. Good. So that's what we do under variable overhead expenditure variance. Then the next thing is variable overhead efficiency variance. So variable overhead efficiency variance, how do we deal with it? Variable overhead efficiency variance. Variable overhead efficiency variance. It is standard hours. Standard hours in actual production minus actual hours, then standard rate. So it is the same thing. The standard hours in actual production minus actual hours. And we all know where we're using standard rate for the labor, we're talking about variable overhead absorption rate. Standard hours in actual production. The same thing you are getting up here for the labor, because this depends on labor hours. It will be the same item we transfer down here. So it will be 5 times 1,400 minus actual hours, 6,800. Instead of multiplying by 100, the standard rate for labor hours, we multiply by variable overhead absorption rate, which you are able to see for 20. We talked about favorable. It is the same thing. The difference between 7 and 6,800 is 200. 200 by 20, what will we have? 200 by 20. Is it 4,000? Is it 4,000? Let me give you like 1 minute to confirm. Is it 4,000 favorable? Is it 4,000 favorable? 4,000 favorable. Thank you. Let's go to the next thing. We're done with the variable overhead. So we're going to the fixed overheads, which again is always interesting. So fixed overheads, we can talk about fixed overhead rate variance. It is fixed overhead expenditure variance. Fixed overhead expenditure variance is equal to budgeted fixed overheads minus actual fixed overheads. Budgeted fixed overheads is equal to fixed overheads absorption rate multiplied by actual activity level. So can we get budgeted fixed overhead? It is fixed overhead absorption rate. What is our fixed overhead absorption rate? What is our fixed overhead absorption rate? Somebody? Very fast. Our fixed overhead absorption rate. If you've been in this class, then you'll be able to tell us what our fixed overhead absorption rate is. What is our fixed overhead absorption rate? What is our fixed overhead absorption rate? What is our fixed overhead absorption rate? Fixed overhead absorption rate, fixed overhead. What they are 10 shillings per hour, right? So it is 10 shillings per hour. We multiply by actual activity level. You can clearly see our fixed overhead is also dependent on what? On labor hours. Our fixed overhead is also dependent on labor. It is also dependent on labor hours. So what is our labor hours? Actual labor hours? 6,800. Right? So that will give us 6,800. Give us 6,800, right? That will give us 6,800. When we come to we come to fixed overheads, right? So fixed overhead expenditure variance, is equal to budgeted fixed overhead, which is 68,000 minus actual. So what are the actual fixed overheads? Actual fixed overheads in 60,000. What will we do with this difference? Is it something to be happy about? Yes, they have saved how much? 8,000 variable. That's our fixed overhead. Then we go to fixed overhead efficiency variance. So fixed overhead efficiency variance, how do we deal with it? Fixed overhead efficiency variance. Fixed overhead efficiency variance. Fixed overhead efficiency variance. How do we deal with it? Acha tuone kama watu wataresolve for this last part. Can you just post the formula there? Fixed overhead efficiency variance. Following what you have been doing and looking at that activity, you must identify that activity level. In some questions, it will be units of output. In other questions, it will be overhead hours. In some questions, it will be labor hours. So what do we have? Just write the formula down there. Tupatie formula down there. Tupatie formula. Someone who has been following what we are doing, please help the team. Or just try. Remember, it is not a final thing, so you have an option of trying. Fixed overhead. Fixed overhead expenditure variance or efficiency. Fixed overhead efficiency variance. Fixed overhead efficiency variance. Fixed overhead efficiency variance. Wacha tuone what this is giving us here. Number one, standard hours in actual production minus actual hours multiplied by fixed overhead absorption rate. That's what my friend has given us. Another person, standard hours in actual production minus actual hours times fixed overhead. Great. Any other difference answer? Any other different answer? Someone with a different opinion? Any other person with a different opinion? Any other person with a different opinion? So budgeted fixed overheads minus actual fixed overheads. Hiyo tumetumia hapa tu. Budgeted fixed overheads minus actual fixed overheads. We are doing what we call fixed overhead expenditure. Fixed overhead efficiency, we are repeating this one here, but instead of variable overhead absorption rate, we are talking about fixed overhead absorption rate, right? Why are we doing that? Our fixed overheads were being absorbed based on labor hours, not units of output, based on labor hours. So it's going to be standard hours in actual production minus actual hours multiplied by fixed overhead absorption rate. So do we have the two? Standard hours in actual production. It just comes to labor efficiency variance. 5 by 1400 minus 6800, right? Compare the two, that will be 200. Then multiply by fixed overhead absorption rate. So fixed overhead absorption rate in that is 10. What is your variance? 7,000, 1,600, it is favorable, of course. A difference of 200. By 10 in happy. A difference of 200. By 10 in 2,000. 2,000 favorable. 2,000 favorable. Are these things making sense to somebody? Because if they are not, we must get back to the drawing board. Are they making sense to somebody? Are they making sense to somebody? Great. I want to introduce two things and you'll be able to understand why it will be the reverse. Though under expenses, it will be the reverse of what you have been dealing with. Number one, we are talking about fixed overhead volume balance. Number two, fixed overheads, capacity variance. Fixed overhead, capacity variance. Fixed overhead, capacity variance. Fixed overhead capacity variance is equal to budgeted hours minus actual hours. Budgeted hours minus actual hours, then you multiply by fixed what? You multiply by fixed overhead absorption rate. You multiply by fixed overhead. Fixed overhead absorption rate. Very simple. The only difference, the only difference is, under this, we are talking about standard hours in actual production. It is standard hours in standard or budgeted production. So that's why we talk about budgeted hours. Budgeted hours in, we can put it somewhere here, in budgeted production. I think this will make sense. Good. So we are able to see standard hours was 5 hours per unit, right? It was 5 hours. It was 5 hours per unit. But now it is not multiplied by actual production. It is multiplied by budgeted production. So as per their budgeted or standard cost cut, how many units were they supposed to produce? What was the budgeted production? You multiply by 1,000. Actual hours, I get changing the same thing. Fixed overhead absorption rates, it is still 10. So 5 by 1,000, that's 5,000. They have 5,000, they ended up with 6,800. That's a difference of 1,800. By 10, itakuwa ngapi? 1,800 by 10 itakuwa ngapi? 1,800 by 10 itakuwa ngapi? 1,800 by 10 itakuwa ngapi? 18,000 at first. They spent more this time, right? They spent more. I want to squeeze this space here and just bring the last one. The last one is called fixed overhead volume variance. Is equal to budgeted quantity minus actual quantity multiplied by fixed overhead absorption. Hapa sasa tunashika watu tena. So budgeted quantity. How many units did they budget to produce? Budgeted quantity ni ngapi? Budgeted quantity. Repeat. Fixed overhead capacity variance is equal to budgeted hours in budgeted production, not budgeted hours in actual production. Or we of course talking about standard. So it is standard hours in budgeted production or standard production. So that's why we basically take it as budgeted hours, total budgeted hours as per the budget. Under this part, budgeted quantity 1,000. Actual quantity ni ngapi? Yes, this question actually is perfectly serving my interest. 1,400. Fixed overhead absorption rate ni ngapi? 10. Give me the variance before even we get to the answer. What is the variance? 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 The difference is 400 by 10. Wow. So if you've given us adverse, just know your answer is wrong, and I will explain why. If you're giving us adverse, just know your answer is wrong, and I will tell you why. So assume fixed cost is 4,000, right? So fixed cost is 4,000. Is 4,000, right? And you want to produce 3 different units, right? 4,000 then units, quantity produced. Hapa will produce 1,000, or actually, hapa we produce 10, hapa we produce 100, hapa ni 1,000. I want to give the production cost, fixed production cost per unit, right? Fixed production cost per unit. When your fixed cost is constant and you produce 10 units, your fixed cost per unit will be 400. When your fixed cost is 4,000 and you produce 100 units, your fixed cost will reduce to how much? To 40. When your fixed cost is still 4,000 and you increase the unit to 4,000, your fixed cost will now be 4 shillings per unit. Yes, we are doing that. Don't worry, just 1 or 2 minutes. Increase in volume of output reduces production cost per unit. Increase in volume of output reduces production cost per unit. When you only produce 10 units, the cost will be 400 per unit. When you increase the units to 100, the cost will be 40 per unit. When you increase the units to 1,000, the cost per unit will be 4 shillings. You are reducing the cost as the volume of output increases. When you come to this part, they budgeted to produce 1,000 units. And you can tell the production cost per unit. When the units increased to 1,400, we will be talking about favorable volume of output or adverse? We will be talking about favorable or adverse volume of output. It is favorable. It is following this rule. It is following this rule. As the volume increases, cost per unit reduces. So in the moment we see budgeted quantity is less than actual quantity, then what are we talking about? We're talking about favorable fixed overhead volume variance. Fixed overhead volume variance. So now, before even you forget anything, it is only 3 variances that disobeys all the formulas that we have here, whereby if you get a negative, you give them a positive variance. If you get a positive, you give them a negative variance. So under sales, it is selling price and sales margin volume variance. Under cost, it is only fixed overhead volume variance. That is the only variance. Those are the only 3 variances that disobeys the rule we are having in the formulas. The remaining variances, if you get a negative, it is adverse. You can confirm. Any of them, if you get a negative, it is adverse. If you get a positive, it is favorable. But now, these 3, you take the reverse of what you are getting. For example, you are getting negative. We talked about favorable. You are getting negative. We talked about favorable. At this point, my good friends were getting negative, but we have to take the reverse. If you master what I've displayed on this board, you don't need to do anything under this topic. You just need to wait for topic number what? Number 6. So sorry for that. Let's have our 5 minutes break. Then we come back with the August 2022 question. So let's have our 5 minutes break, please. Budgeted quantity of output. If you look at our question under the standard cost card, how many units were to be produced? They budgeted to produce 1,000 units. They ended up producing 1,400 units. What have we said? Okay, I want us to pick it from this point. You are in business, you are doing wholesale, right? Maybe there are these parcels that are being sent to you. So if one parcel is delivered to you, if one parcel is delivered to you, or 10, let's say if 10 are delivered to you, you will be charged 400 per unit of this 10 to give you 4,000. If they deliver 100 parcels to you, you will be charged 40 shillings per parcel. If 1,000 parcels are delivered to you, you will be charged 4 shillings per parcel. Which option will you go for? If you are to receive your items in form of parcel, which option will you go for? The amount does not change, but the quantity will be changing, right? The amount you're going to pay, they're charging you 4,000. Whether you deliver one, they charge you 4,000. But if you only request for 10, you'll be paying 400 per unit. At the end of the day, you pay your 4,000. If you request for 100, at the end of the day, they are going to charge you 4,000 for the 100 units. But if you look at the cost per unit, it is 40. So which one will you go for? Which one will you go for? Assume you are receiving parcels and those are the charges. Which one will you go for? Which one will you go for? You will tell them to deliver 1,000 units because at the end of the day, you will pay the same amount, 1,000. But if you look at the cost per parcel, it has reduced to 4 shillings per parcel. So is your question taken care of? Is your concern under this part taken care of with that explanation? Is it addressed? Correct. So that's what you need to understand by looking at this logic, the volume of output. So I talked about, we have a question from August 2022. We have a question from August 2023. They are all discussing, they are all talking about standard cost cut. So I'm going to do one if time will allow me, but should you find time, please do the other one to confirm whether you are able to understand these questions. Number 2, you can actually, during your free time, try to come up with a reconciliation statement of what we have done here. Try to come up with a reconciliation statement. That's how learning takes place. But if you do everything in class, utakosa to solve. So just try and use this question here to be able to do what we call reconciliation statement. Of course, we've done a lot of things under this question, but of course, the examiner wanted you to add very few things: material price, material usage, labor rate, labor efficiency, fixed overhead capacity, and fixed overhead efficiency, which I believe we've actually done in this particular question. But we've gone ahead and looked at other separate items which were not requested for. So let's go to August 2022. Question number, question number 5B. August 2022. It should be our last question under this topic. August 2022, question number 5B. It should be our last question under this topic. What did I say? That the examiner, we've been able to see we have standard, actual, then we get variances. So this time round, you are given actual and variances. So you have to go back and give us the standard cost cut. So that's where now the variable overhead absorption rate, the fixed overhead absorption rate will be giving us a lot of headache. The variances, the favorable and the adverse, will be giving us a lot of headache. But of course, with this elements and all that, we'll get what is happening. So you're being told the following information relates to actual output cost and variances for the month of May 2022 for a single product branded tea manufactured by KK Limited. Actual production, actual cost incurred, we have material, all these are actual. Then below it, we have variances. Direct material, material price, material usage, labor rate, labor efficiency, and all that. Additional information. There was no opening or closing work in progress during the period. Variable production overhead varies with the labor hours worked. The company operates the standard marginal costing system. Standard marginal costing system tells you that the fixed production overheads do not form part of product cost. The fixed production overheads do not form part of product, not form part of product cost. Great, so let's go ahead and come up with the standard cost card. So our standard cost card, we start with the variances that we have there. The first one is direct material. So material price variance. Material price variance is equal to standard price minus actual price then multiply by actual quantity. Right? That's our formula. So do we have material price variance? If yes, please give me the variance. The sign is very important. Do we have material price variance? Very fast. Material price variance. Watu wamenyamaza. Material price variance. Direct material price variance. 300,000 favorable, positive 300,000. So positive 300,000, we are not going to use the signs. Positive 300,000 is equal to standard price. We don't have standard price. That's what we are looking for. Minus actual price times actual quantity. So do we have actual price of raw material? Do we have actual price of raw material? Direct material, 300,000 kgs. And the total cost is 8,400,000. Right? I believe these people are able to see what we are doing. Everyone is able to see what we are dealing with. Right? They are talking about 800 or 8,400,000, right? That is the total material cost divided by 300,000 kg, which is the actual quantity. It will give us actual price per unit. Then actual quantity is 300,000 kg. Good. It is not about looking at the variance, whether favorable or adverse. This time round, we need the unknown item, which is standard price. So let's break the brackets. Let's break the bracket. Let's break the bracket. What are you getting? 8,400,000 divided by 300,000. Unapata ngapi? Unapata 28, right? Good. So let's look at it from this point. We have 28 multiplied by 300,000. It takes you back to 8,400,000. So let's break the bracket. Let's break the bracket. Let's break the bracket by multiplying what is in with what is outside the bracket. So 300,000 positive 300,000 is equal to 300,000 by this will be 300,000 standard price, right? Standard price minus 8,400. So can you get the unknown figure? So standard price 300,000 standard price is equal to this 84. If it crosses the equal sign, it will be a plus. Are we all getting 8,700? Are we all getting 8,700,000? Are we all getting 8,700,000? So give me the value of SP. Divide both sides by 300. Give me the value of SP. What is our standard price? Standard price, we're talking about standard cost card for a unit of product T, right? Product T. That's what we are preparing, right? Standard cost card of a unit of product what? Of product T. So the first thing, when you're preparing the standard cost card, you can refer to our previous question. It was direct material, right? Direct material. So how many kgs do we need to produce 1 unit of T? We still don't have standard quantity per unit, but we already have standard price. So what are you getting? 29. We have 20 what? 29. Good. Now, are we able to proceed to material usage? Material usage variance is equal to material usage standard quantity in actual production minus actual quantity multiplied by standard what? Standard price. So this time around, we already have standard price up here. Do we have any other item? Because we cannot solve 2 unknown items. Never. We must just have 1 unknown item. So if we have material usage variance, please post it down there. Material usage variance, material usage variance. Sasa watu wataoni variances. Material usage variance negative 180,000. So negative 180,000, right? That is the material usage variance, is equal to standard quantity in actual production minus actual quantity. Do we have actual quantity of raw material? Yes, 300,000 kgs. 300,000 kgs. Then we need to multiply that by what? By standard price, which we already calculated up by 29. We need to break the brackets, right? So negative 180,000 is equal to 29. We are breaking the brackets. Standard quantity in actual production minus 300,000 by 29 Ningapi? 300,000 by 29 Ningapi? 300,000 by 29. 700. 700, right? Good. Now we want to collect the like terms. Of course, this one will cross the equal sign. If it crosses the equal sign, it will be a plus, right? So we have 29 standard quantity in actual production is equal to, so 8,700 is a minus. If it crosses, it will be a plus, right? So we have negative 180,000 plus now 8,700,000, right? Then we need to break that. So what are we having? Can you get the difference here very fast? First, I'm going to let down 29 standard quantity in actual production is equal to the figure. What are we getting? 85 what? 8520. We have 8520,000. So we want to get standard quantity in actual production. Divide both sides by 29. Divide both sides by 29. What are you getting? Standard quantity in actual production in happy? Standard quantity. Standard quantity in actual production. Unapata ngapi? Sasa mtameshindwa. What are we getting? 293.7. 293.793. Point what? Point 1034. Good. Standard quantity. Standard quantity. Actual production is equal to 293.793.1034. Good. Do we have actual production? Because what we need is standard quantity. So can we get standard quantity? Standard quantity is equal to this divided by actual production. So what do we have? Actual production. We are producing finished product, not raw material. So what is our actual production? What is our actual production? The name, actual production. Actual production of the finished product, 36,000. Good. Give me your answer. Rounded up with decimal places. So how many kgs? How many kgs? How many kgs? How many kgs? How many kgs do we have? Round off your answer to 2 decimal places. Round off your answer to 2 decimal places. 8.16 what? Kgs. 8.16 kgs. Lakini selling price or purchase price per unit of raw material is 29 shillings. So when you go to standard cost card, just refer to what we did or what we are given under the standard cost card. They say direct material, so they need 8.16 kgs at shillings 29 per kg. Then they normally give us the amount here. So can you give us the amount? When you take 8.16 kgs to make 1 unit of tea, and the cost per unit or cost per kg is 29. So what was the cost of raw material utilized? to produce a unit of product T. 8.16 times 29, 236.64. 236.64. Are we all getting that? Are we all getting that? Are we all getting that? If you participate very well, we'll be able to get all the answers almost immediately. Are we all getting that? Are we all getting that? Are we all getting that? Great. Let's go to labor. Let's go to labor rate variance is equal to standard rate minus actual rate times actual hours. So what do we have in the question? Do we have labor rate variance? If yes, post it down there. Labor rate variance ni ngapi? Labor rate variance, direct labor rate variance. 160,000 and less. So negative 160,000. Negative 160,000 is equal to standard rate, which we do not have, minus actual rate. Do we have actual labor rate? We are given actual labor cost. That is 54.40 divided by actual hours will give us actual rate. Will give us actual rate. 64,000 hours. This will give us actual rate. Then we multiply by actual hours, which remains to be what? Good. So let's break the bracket. Let's break the bracket. Sasa watu wafanye hesabu. Watu wafanye hesabu. Watu wafanye hesabu is equal to what? 64,000 plus R minus 4. Minus 54. Good. So can you give me the answer there? I want you to work it out and give me SR. Kuna mwenye ameshindwa, so wacha tumsaidie. Good. So once we have this, we only have one unknown SR. So take these a minus. If it crosses the equal sign, it will be a plus. So 64,000 SR is equal to 54.40 minus 160,000. Right? We need SR divided by 64,000. Divided by 64,000. So give you the numerator and then you divide by the denominator. I'm told SR is equal to 8 watts. Standard rate. So that is shillings. Standard rate. Are you all getting that? Ama ni mtu mmoja ndiye anapata hiyo? Are we all getting that? Are we all getting 82.5? Thank you. Let's move down and look at the labor efficiency variance, which will give us now the labor hours utilized of the standard labor hours. So labor efficiency variance is equal to standard rate. Sorry. How effective are you utilizing your labor? Standard hours in actual production. Right, that was the formula, minus actual hours. Then we multiply by what? Standard rate. Our standard rate up. Standard rate. So look at the question first of all and tell us whether you have been given labor efficiency variance. Have you been given labor efficiency variance? If yes, please post it down there. And the sign matters. Is it a positive or a negative? Is it adverse or favorable? That matters a lot when you're doing the reverse calculation. What are we getting? What are we getting? That is a labor efficiency variance, 320,000 favorable. So that is positive. Positive 320,000. Positive 320,000 is equal to standard hours in actual production minus actual hours. Do we have actual labor hours? Yes. 64,000, right? In bracket, standard rate, which is 82.5. 82.5. So I want us to work this backwards and see what we're going to have. Can we break the bracket? When you take 64,000 by 82.5, what are you getting? What are you getting? if you take 64,000 by 82.5, tunapata ngapi? 52. Is it 5290 or 5280? 5280. So you're going to have, what we are having after taking the bracket, right? With a minus, if it to the equal sign, it will be a plus. So we have 8290. 5280, sorry, 5280. We have 5280,000. It is a negative. If it crosses the equal sign, it will be a plus. And of course, we have positive 320,000. So if you break this one here, you'll be able to give us. So that's divided by 2.5. 82.5. 82.5. Good. So what is your standard hours in actual production? What is your standard hours in actual production? What is your standard hours in actual production? We should be able to finalize on this list. Standard hours in actual production. Sasa watu wamepotea. Watu wamepotea. Watu wameamua kutoroka. I need standard hours in actual production. Standard hours in actual production ni ngapi? 67,878. .7879. That is standard hours in actual production. So you want to get standard hours per unit. So standard hours is equal to standard hours in actual production divided by active production. Right, so we have 67,878.7879 divided by 36,000. What are you getting? Standard hours 1.89 hours. Even though the labor rate per hour is 82.5 shillings, for us to produce 1 unit of tea, we need 1.89 hours. So if I have to come up with a standard cost cut, direct labor will be 1.89 hours at shillings at the rate of 82.5 hours per unit. Sorry, shillings per hour. Shillings per hour. How much will you have? How much will you have? 189 times 82.5. Tupate your answer kwanza. 155.93. 155.93. Good, there's a mistake. Someone can help us identify that mistake. Do we less 320,000 or we add? So the first thing I want to ask you is, this 320,000, was it positive or negative? Was it adverse or favorable? The 320,000 labor efficiency variance. Is it favorable? Thank you. It is favorable. Good. So 320,000 is equal to standard hours in actual production minus actual hours multiplied by the standard rate. Right? So we have this minus this and this one. Now, I've broken the brackets and consolidated everything. These are negative. We want to make this standard hours in actual production the subject of the formula. So I'm breaking the bracket. 82.5 times this will give us positive 82.5 standard hours in actual production. Negative 64,000 times 82.5 will give us negative 64,000, I mean negative 52,80,000. Negative 52,80 is crossing the equal sign to this side. What will it be? It will be a positive. So that positive 52,80 is this one here. 32 or 320,000 was a positive. Why are we introducing a negative to it? Why are we introducing a negative? So have you identified your mistake? Have you identified your mistake? Or is your problem addressed? Is your problem addressed? Please confirm. Is your problem addressed? Thank you. Let's move to the next part. Our next part is so to the direct labor, we need to bring in variable production overhead, right? So variable overheads. Without wasting time, we just understand they are dependent on what? Variable. Information number 2. What is the cost driver for the variable overheads? What is the cost driver for variable overheads? Is it units produced? Is it labor hours? Please let me know. Please let me know. It is labor hours. And if it is labor hours, why are we going to waste time to calculate 1.89? And that is the cost driver. We just need to carve it down, right? Hours at shillings. So we need to get variable overhead absorption rate. But of course, we're going to do it and get to arrive 1.89. So variable overhead expenditure variance is equal to budgeted variable overhead minus actual variable overhead. Budgeted variable overhead is equal to variable overhead absorption rate we multiply by actual labor hours, right? So can we get this? Do we have budgeted variable overheads? We have budgeted variable overheads, we don't have that. Do we have variable overhead absorption rate? We don't have that. Do we have actual labor hours? Yes. So you can clearly see we cannot follow this route. So the other method, remember variable overhead rate variance. We talked about variable overhead rate variance is the standard rate minus actual rate. And this standard rate for the variable overhead, we are talking about variable overhead absorption what? Rate. Actual rate, then you multiply by what? Actual hours. Actual hours. Great. What did we say? Actual rate. Actual rate. We arrived. So let's see. Variable overhead expenditure variance is the same thing. We have to talk about variable overhead expenditure variance. In short, if a question is given to you, so our previous question, we were having these items. Sorry. In our previous question, you are having budgeted variable overhead, or you were able to get it, right? But now we have two unknowns. We don't have budgeted variable overhead. We don't have variable overhead absorption rate, but we have actual labor hours. So we cannot apply this method. We now move to this other method number 2. Variable overhead absorption rate minus actual rate times actual hours, right? Good. So do we have variable overhead expenditure variance? Variable production overhead expenditure 120,000 advance. So negative 120,000 is equal to variable overhead absorption rate minus actual rates. Do we have actual rates? The only difference was about variable overhead absorption rate. So this actual rate, did you use it somewhere? Did you use this actual rate somewhere? Actual rates. Actual rates. Did you use it somewhere? How do we get actual rates? Is it what? 5220. Sorry, 1520. 1520,000 divided by actual hours. So do we have actual hours? 64,000. 64,000, then you multiply by 64,000 multiplied by 64,000 multiplied by 64,000. So are we getting, what are we getting? Break the bracket, we are going to return that. Then we have 64,000. So we have 64,000 variable overhead absorption rate, right? So these are negative. If it crosses the equal sign, it will be a positive. 1520 plus 120 minus. Remember, this is a minus, but this figure that is going to the other side. So this remains a minus. So our variable overhead absorption rate is equal to 1520 minus 120. We need to be 1400. Variable overhead absorption rate, it will give us this amount. Variable overhead absorption rate. Itakuwa ngapi? When you check 1400 divided by 64,000, two decimal places with you. 2, 1, 1, 2, 2. We can see, just give me two decimal places. Unapata ngapi? Or even, let's try 3. I think that 3 is the best one, 21.875. That is the variable overhead absorption rate. Don't forget, refer to our standard postcard of the previous question. Variable overhead absorption rate, it was this one here per hour. So we are having 21.875 per hour. What are you getting? 21.875 times 1.89 times 1.89 times 1.89. What are you getting? What are you getting? What are you getting? For what? 41.34. 41.34. They told us that the company uses marginal costing method. So when they're using marginal costing method, we don't need to look for the fixed production overhead. So we have direct labor, direct material, direct labor, and variable production overhead. So standard or marginal cost. Marginal cost itakuwa ngapi? Ongeza hivi vitu. Marginal cost itakuwa ngapi? Marginal cost itakuwa ngapi? Marginal cost itakuwa ngapi? Sasa mtu amekwama. Marginal cost ni ngapi? Marginal cost ni ngapi? Marginal cost ni 433.19. 0.91, right? 433.91. So that's what you are required to do. Somebody is now wondering, why have we not used variable overhead efficiency variance? Variable overhead efficiency variance. What we need to give you, variable overhead efficiency variance is equal to, look at labor expenditure or labor efficiency variance. We repeat the same thing, standard hours in actual production, right? And of course, we now have the standard hours in actual production. It was 678.7879 minus actual hours in actual production, which was 64,000, right? Then we divide by standard rate. So for the variable overhead expenditure variance or efficiency variance, standard rate is the same as variable overhead absorption rate, which is the unknown. So what is our variable overhead expenditure variance? Variable overhead expenditure variance, 80,000 favorable. So it is positive 80,000, right? So positive 80,000, can we break the bracket? Break the bracket. Fanya mbio mbio. So variable overhead absorption rate is equal to 80,000 divided by what you have. Someone. E minus this one. Itakuwa ngapi? Will it be 30 what? It's not number 64, 67. That will be 3. 38, 78.7879. What is our VOAR? What is your VOAR? What is your VOAR? Tukitoka sasa. VOAR ni ngapi? VOAR as we disappear. VOAR as we disappear. VOAR 20.6. Sasa watu wataki kusikiza hizi vitu. 20.62. Now, this is what happens. Remember, there's rounding off that that's number 2. The marking scheme will be provided in 2. We have approach number 1. Once we have the variable overheads, you are able to use it and get 21.875. If you use this other approach, you are getting 20.62. So our marking scheme will be having 2 options. We'll be saying it is 21.875 or 20.62 using the other approach. So if somebody uses this and gets to the answer down here, like this, you get your marks. If somebody replaces this with 20.62 and multiply by 1.89, you get your answer down there, you also get your full marks. So long as you've been able to follow the right procedure. That marks the end of topic number 10. Anything we are going to do under topic number 10, it will form part of our revision. So go and research all the topics except topic number 6 that we have not done. So anything that you have which is pending, please bring it on Tuesday before we officially introduce our last topic. And I believe by the end of next week, we should be done with that topic number 6. We should be done with that topic number 6. Thanks for your time. Have a blessed night. Have a blessed weekend. And let's meet on Tuesday.